Okay, welcome back, everyone. Now, let's quickly look at the next case scenario, right? Whereby you will have, they will tell you that, okay, the market value of equity, debt to equity is this. So it could be debt to assets, right? It could be what? It could be debt to what? To assets. Please, sorry, just a minute. Thank you. Okay, now it could be debt to assets, right? So debt to assets means that is debt to equity. Don't forget that your equity is net assets. Don't forget under the what accounting ratio, right? So you may be given like this debt to equity, debt to asset ratio maybe is equals to 10, which means that your debt is 10%, while your asset, which is your what equity, is what is 100%. That therefore you have 10 over what 100. Don't forget that the market value may be given in a percentage or in value. Don't forget, if they say, oh, the market value is given, they may not even give you in value. They may say, oh, the current market price is 2 naira for equity, 2 naira per shares for equity. Now, what is the total numbers of shares? When you multiply 2 naira times the numbers of shares, we give you the market value of equities. The same thing applicable to debt, right? We'll see a case like that. So we proceed. Exclusive, are we good? Okay, it's not so. Okay,
No,
exclusive.
I'm here. I'm here. I'm here. We are,
Maybe you don't go finish your food now.
no, I do.
Okay. So now let's quickly continue from there. So, and if this is well understood, right, we can move on, right? Don't forget that we have explained the worst case scenario, where you will have this. Why am I saying worst case? Well, it's fine. All these worst case scenario, best case scenario are valuation terms. Actually, that is what we use in valuation. So if you have when you have debt to equity, you have this debt to equity, you have this and that. So I will send this note to you. If you have paid, I'll send it to your WhatsApp. Okay, these are the steps. Please, even when you are sleeping, remember these steps. So, they are very what? They are very important. So now let's quickly look at an illustration to this. You can see questions on risk-adjusted cost of capital slash appropriate cost of capital, or they can call it what? Specific cost of capital. Now, there is one question here, hmm, and even in that normal cost of capital without risk, please, all those questions, ensure you attempt them. There's one question here that there's a way I can set the question, right? So there's one diet where they normally pick it from. There's one diet I can test question 2. No, question 5 of that question, right? Now, that is November diet. So in May, I can test question 2 of that same particular test, in that particular test. Now, what test? There is one particular question that I can easier to test in that particular test, right? What if you see it? That is why I said, you see that objective of financial management, just ensure most people will see it and they don't even know where they will start from, right? Please make sure you solve all those questions in that material. It's very what? It's very important. Now, let's quickly look at this question 1. APLC is evaluating the viability of a new project in a different industry. Now, AP now is the main company. Why do I know that it's a main company? Because they already say they want to evaluate new projects in a different industry, which means that they want to diversify. Don't forget all these things, right? Which means that they want to diversify. Now, BPLC operates in the same industry as the what? As the new project. You can see that the BPLC is the proxy company now. Is the what? is the closing company, because that is the company that is the industry they are diversifying into. Why A PLC is the what? Is the main company, right? You have the following additional information, right? You have A, B. Equity beta for A PLC is what? Is 1.2. For B is 1.90, right? You can see debt to equity ratio, right? You don't need the book value here. You don't need the book value, because what you need is debt to equity market value. You don't need book value. So you ignore the what? The book value. When you have something like this is it's just like a trap. It's a trap. You quickly go and use book value. That is wrong, because we say VE is the market value of equity. VD is market value of debt. Now, in this case, the market value is given in percentage, right? You see one, you see you see 0.20, right? You see it. Now, the tax rate. Don't forget that when you are given a question like this, right? First thing is to read the required, right? Now, the required says that calculate showing all relevant workings, the appropriate value of debt to be used in computing the cost of what? Equity for the what? For the new project, which means that they say we should just compute the cost of equity, which is the equity what? For the what? For the new project. Now, when you look at that will be used for the new project. Now, when you look at these steps, when you look at these steps, right? And your BE is equity beta. From your BE, you come to your what? Where you will use CAPEB to determine the cost of what? To determine the cost of what? To determine the cost of what? Equity. So now, in this case now, let's quickly move down. Okay. Now, in this case now, from step 1 to step 5, they did not give us the cost of equity. They didn't give us any element of CAPEN. It is not given. Any element of CAPEN, risk-free, risk premium is not given. So this is to tell you that you will just stop your calculation. You just stop it here, which is BE, which is your equity beta. Then you leave it like that, because you are not given more information about the CAPEM so that you will use to determine the cost of equity. So you just stop at equity beta and you leave it, like that, because any other information as per the what is it called, as per the risk premium or risk free and all that, it is not given in the question. Now let's quickly start. Suggested solution, suggested solution, right? Now, the first, what is our first step? Unmute your mic. What is our first step? Step one. Step
Identify
one.
the policy company.
Thank you. God bless you. So, identify the policy company. Class, what is the policy company here? Policy company
B.
B. Thank you. So, the policy company is BPLC, right? PLC. So, what is step two? Step two,
Better
class.
assets.
Okay.
Ungeared.
We have to, okay, we have
Ungeared
to,
the policy company.
so we ungeared, we de-gear or ungear by removing the financial risk of the what? Of the
Of the
policy company. Is that
plastic
not so?
company. Yes.
Yes. So now it's for the policy company. All this information is for the policy company class. Now let's go there and check. Let's see what we're given. Okay. Now, if you look at, okay, let me bring it out. Now, is better debt, BE, of course, we'll get our equity better. Value of equity. Now, from this question now, look at our formula, right? Now, better debt for the closing company. Is it given? Better debt of
No.
the closing company. Look at it. Is better debt given in this question? No,
No.
right? Better debt of the closing company. There is no better debt of B PLC. You can see there is no better debt of B PLC, right? So automatically your BD will become 0. So you don't need this part again. You don't need all this part again because your better depth is not given to you, right? You don't need this again. So you quickly will remove this part, right? Because the better depth is equals to 0. Don't forget, because the better depth is not given in the what? In the question, class. Class is not given in the what? Question. By removing the financial risks. Financial risks of the Proxy company. Okay. Now, if this is established, we go on. First of all, let's bring out our variables. We need to bring out our variable. Don't forget, everything is for the Proxy company. BE is equity beta, oh class. BE is equity beta for the Proxy company. Equity beta, right? Now, what is the equity beta for the Proxy company, class? Equity beta,
1.9.
1.9.
okay, thank you. 1.9. So 1.9. So now the VE is the market value of equity. VE, market value of equity, right? VE. Then the VD is the market value of debt, which can be given in a percentage as well as in figure. C is the tax rate of the Proxy company. Tax rate, tax rate, tax rate. Now, let's go. Let's check. So now, the tax rate for the Proxy company is what? Is 30%.
30%.
And this is how you will, class, this is how you will see, even if they give you a question that is 10 pages and they say, oh, appropriate, this is how you will read the question, identify every element there, identify it and bring it out. All right, and that is how it is. Now, if that is established, it's 30%. Don't forget that you can see they say debt to equity ratio, book value, market value. What we need is market value. We don't need book value, class. We don't need book value. We need debt to equity ratio for book value, right? For the Proxy company, and it is 1. It is 1, right? 1. It is what? 1, right? That is like, what we give you 1 is 100 divided by 100. Is that not so? Is that not so?
Yes.
Yes.
Okay. Okay. It's 100 divided by 100. You can see the APLC is 0.20. They've already converted it. 0.20 is 20%, right? They've converted it. So this 1, you can leave it as 1 safe. Or you can just say it's 100, right? Let's convert it. Oh, it's 100, right? Now, we go on, then you bring the level of gearing. You say the gearing, right, is debt to equity. Debt to equity. Okay, debt to equity equals to, so gearing. Debt to equity is 100, right? You can use 100%, or you say is 1, or you can say is 1. 100 divided by 100 is 1, class. 100 divided by 100 is what? Is 1, class. 100 divided by 100 is 1. So value of debt, right? Let me put it here. Value of debt is equals to 100 or 1. Value of equity is equals to what? Is 100, because it is just 1, which is 100 divided by 100 is what? Is 1. So the tax rate is 30%. The tax rate is what? Is 30%, right? Then now you can now put all these things in your what? In your what? In your formula. Now let's go there. What do we have? So equals to BE. What is our BE? Class, what is our BE? 1.90 times, what is our BE? right? 100 class. Are we still together? Divided by VE, right? Divided by VE. Okay, VE, which is 100 plus VD, which is also 100. What is debt? Is 30. 1 minus 0.3. So in case you don't know how we get 0.3, let me put it out again. So you understand. So, or 0.3, right? Class, give me figure. What is the final answer? What is the asset beta?
1.17. 1.12.
1.12, right? The asset beta is what? Is 1.12. Someone should confirm that.
Yes, it's correct.
Okay, 1.12. Okay, that's fine. So what next? If this is established, step two. Step two.
Regia.
Okay,
Step
oh.
3.
Step three, thank you. Step three, right? Now we'll not be writing all these steps again, though. We just do like two of these so that you get acquainted to how it works. Don't forget that the question says that we show all relevant workings, the appropriate value of beta, just the beta, to be used in computing the cost of equity. Don't forget that you will use equity beta to determine the cost of equity. Don't forget you can see it here, you use equity beta so that equity beta that you will use to determine the cost of equity, and that is why we will stop here, and that is what the question says we should do. Sometimes the question will just tell you that calculate the appropriate cost of equity using CAPM. You will just stop at your you will just stop in this CAPM. You just stop there. Sometimes the question will say, oh, calculate the appropriate cost of capital. When they say appropriate cost of capital, you will end it here. Class, pay attention. That is why I say when you collect your question paper, read the requirement, read the required, understand it before you move on. Now, the question says the beta that will be used to calculate equity. Of course, cost of equity. Of course, you need equity beta. That is why we need to stop here there in step three. Another question may say, oh, calculate the cost of equity, appropriate cost of equity using the CAPM. You will now say, using CAPM. How now? Just stop at this step 4 and leave it and use it to discount your project. Probably you are doing your capital project investment, right? Now, the next one is that, oh, calculate the appropriate cost of capital. Just end it here. And that is the appropriate cost of capital, right? That is the three-case scenario. Class, take note of that. Now, we move on to, okay, the next step, which is, oh, let me copy this formula. You're supposed to know it, so please, if you don't know this step, you will not join my class, right? So our next class is on Wednesday, right? So you must know it. You must know the 5 steps, right? You must know the 5 steps. You must understand it. So if this is established, I'm coming. Okay, step 3. Now, excuse me. So we have regear we need to include the financial risk, by including the financial risk of the main company, right? Don't forget that the equity beta, don't forget that the equity beta that you calculate, the asset beta, sorry, the asset beta that you calculate is the business risk, right? In that industry, right? In that industry. So you will now add the financial risk of the main company. So when you are adding the financial risk of the main company, then it becomes of the main company by including the financial risk of the main company. So it becomes what? Equity beta. Don't forget where I highlighted like this. This part is for the main company. Just check for information. The value of debt of the main company, the value of equity of the main company, the tax of the main company, beta debt of the main company class. I hope I'm communicating, right? Why the other part here is for the what? Is for the prosy company class. Is for the what? Is for the prosy company, right? Right? Now, if that is established, so we continue with BE equals to, right? We've already calculated the asset beta to be 1.12, right? Asset beta to be 1.12. Asset beta BA. Don't forget, let me bring the element out so that you know. You see it. Okay, come. BA BA equals to 1.12 value of debts, right? For the main company, value of equity for the main company, right? Right? Tax of the main company, right? Tax rate. Sometimes their tax rates may be different, right? So now what is the level of gearing? We quickly go back to the question where we have gearing, right? So debt to equity. Debt to equity equals to, so what is the debt to equity ratio of the main company, right? Debt to equity. So debt to equity ratio, you can see it. Class, can you see it? Are we still there? Hello?
Yes, we are
Yes,
here.
sir. We are with you, sir.
Okay. So now, what is the market value? That is 0.20. That is 20%, right? 0.20 is 20%,
20%. Yes, sir.
right?
Yes, sir.
Okay. Okay. So we can have 20%. Yes. So if this is 20%, what it means is that your debt will be 20, class. Your debt will be 20, then your equity will be what? Will be 100. So it's still the same tax rate of what? Of 30 what? Of 30%, right? Then you can now put it in your in the formula. Now, what is the formula? Is BA. BA here is 1.12. We've calculated this. Don't forget that asset beta sometimes may be given to you in the question, that you don't need to stress yourself, right? May be given to you. Plus, open bracket, BA 1.12 minus beta debt. There's no beta debt here. Beta debt is not actually given in the question, both for the POSI company as well as so beta debt will be 0, right? As well as the main company. So if it is not given, it will be 0. So what is the value of debt of the main company? Is 20. The close bracket 1 minus 0.3, right? Then this. Don't forget that you do this first. Let's do it like this. So what do you have? Divided by class. I'm coming. Divided by the value of equity, which is what? 100. Please, if you don't understand what we are doing, mute your mic. Talk. So class, give me figure. Figure. I will just call him now. I know if I call him, the person will give me figure. Should I call him? What is the BE? Where we will stop, which is the equity beta that will be used. What is your BE class?
1 point.
You do this one first, then you add it with 1.12. Okay, you say what is the figure? Figure. Rachel, probably you change your bedroom voice. You say, give me figure. I don't know, maybe it's
1.12, sir.
okay. 1.12, just 1.12.
1.123. That's it.
Okay, okay, okay. Since we are using three decimal, right? You can use 1.12, right? Or 1.13.
1.12.
Okay, 1.12. Okay, it's fine. Okay, 1.12. Okay, okay. So,
I'm getting 1.26.
so another person, interesting. Please solve for this. Multiply it by the inbox. Then you now add it. Or should I say, my people, okay. Let's say this equals to 1.12 plus, yeah, solve for all these ones and give me a figure so that I will add it. What do you have? Do 20 minus 1 this divided by this times 1.112. Then let's, so that we'll add with this. What do we have?
1.26.
Okay, 1.26. Okay, there's no need for me to okay. Let's go.
1.276.
8.
1.226.
1.276.
Okay, 1.276.
6. Either ways. Because I tried
Okay,
the change of formula
let
and I also did.
wait. Let's leave it two decimal place, right? Our beta is asset beta is 2. Let's just leave it two decimal place, right? Right? Let's just leave it two decimal. 1.27 or 1.28. All join. Right? Right? 1.27 or 1.28. Two decimal place. So this is the
1.276.
27. Just say
Yeah,
two
1.27.
7 6.
Yes.
Okay, 1.276.
7, yeah.
Okay, 1.27. Okay. So this is the equity beta, right? This is equity beta that will be used to calculate the cost of what? The cost of equity. And this equity beta contains both the business risk of that industry as well as the what? The financial risk of the what? Of the main company. Class, I hope we have answered this question correctly. Abi? The appropriate value of beta to be used in computing the cost of equity for the new project, and that is the appropriate cost of appropriate value of what? Beta. So now, if this is established, let's really go to, before we finish our class, right? So let's quickly look at this question as well,
So please
right?
scroll up a bit again. Sorry, no vex.
How much will you pay?
Yeah, don't worry, don't worry. I've got what I want to get. 100 over
Okay.
100.
Maybe the
Thank
video will
you.
drop on YouTube now. We'll just rewatch.
Abina.
Yeah, yeah, yeah.
So so some like exclusive now. Exclusive don't want to use his data to, he's trying to economize.
No, it's not
Okay.
economize. It's just most times it's just time.
Exclusive. Stop
Okay.
explaining. They want you, they explain.
I prefer to join the class. I prefer to join the class.
Oh, where are ladies in this platform now? Where are they? Are they just muted? Where is
We are
Rachel?
here.
Where is Laura? Oh, Mama. Okay. That's fine. Okay, where is Abidemi? I see you. Abidemi, unmute your mic.
Yes, I'm here.
Okay, that's fine. So no, Mona, no allow guys come take over this class, I beg. So now let's quickly look at this second question. Where is comfort? Oh, comfort. Where is comfort? Felicia, are you sure you are still with us or against us? Okay. Now KKPLC. Another question. KKPLC before we go. right? KKPLC suggested solution. Now, KKPLC is considering project O. You can see KKPLC is considering another project, which is project O. KKPLC, you can see the project O is the project company because that is the company that is the business, that is the company that is into that business they are considering, right? And that makes it what? A project company. KKPLC has the following financial data, and this is how question will be given to you in the question, where they will separate the project company as well as the main company. You will be the one to actually do that. Now, the cost of debt, you can see the cost of debt after tax is given as this. Then the cost of capital is given as 16%, while equity beta is given as what? Is given as 1.3. Now, that reminds me, let me go back to this part. Now, I did not explain something here. Class, do you know that when an equity beta, now let me quickly explain this now. When equity beta, you can take notes, please take notes, because the question may say, briefly explain when equity beta is 1.20 or 1.20 and 0.1. What is the implication on the company stocks? A company that have a beta will be a listed company, either listed in the Nigeria Exchange Group or listed in the London in the London Exchange, right? Right. Now, in that part, you can they are listed. You can quickly see their beta. There are some places that we extract information. If you want to analyst, there's investment analyst. There are some places you extract your information on company stocks when you want to do valuation or you want to do some analysis, right? Now, you now see that this company beta is, let's say, 1.27. Now, what is the implication? This implies that the company stocks is what? Is risky, right? And don't forget, as an equity shareholder, the higher the risk, as an investor, as a prospective investor, the higher the risk, the higher the return. You buy Jitco Bank shares. You don't know. You are expecting something from your investment. You don't know what you are expecting, right? It is a risk you are taking, right? Now, if the company equity beta, when you now check the financials, right? Maybe most especially the London or the NGS, you can check my videos. Maybe after Ican, then you can check my videos on that. So when you check, you now see that the equity beta of that company is greater than 1. When it is greater than 1, it implies that the company stocks is what? Is risky, right? And some investor may, like a rational investor or an aggressive investor or a risk appetite investor, may decide that, oh, let me go and buy equity beta. Oh, it's risky. I always enjoy something that have more risk. When we get to portfolio theory, we'll still explain more. Now, when it is less than 1, what is the implication? It implies that that company stock is riskless, right? The risk attached to it is minimal, right? Those people who have a risk adverse, who are risk adverse investor, we look at it, oh, let me quickly go and invest. So back to class. So a question may tell you that I've seen so many questions like that explain this also company, explain the beta of 0.2, which is less than 1, and as well as explain the beta of 1.2, and it is about 3 marks. Imagine you just need 2 marks to move. That one self is okay. You are good, right? Now, and that is that part. Which other thing I want to explain? I think that's all. Okay, now let's quickly move on. Please take note of that when beta is greater than 1, as well as when beta is what? Less than 1. Now, if that is established, let's quickly continue our class, our analysis on this question. The cost of capital. Now, the cost of capital given to us here does not include the risk. You can see the cost of capital, they've calculated some cost of capital before and it has 16%. Then if a company is considering new projects, you can't use that existing cost of capital to discount the project because the cost of capital does not include the risk of the new what? Of the new project. Right? With that, if you are using it, you may end up having a project that is not viable. Of course, when you use it, you may think that, oh, this project is viable. Okay, let's go on. At the end of the day, they will owe you as a financial manager or as a CFO, right? Or as the company financial advisor, you advise them on what to do, right? Now, we have equity beta of 1.3 and asset beta is given as 1 point what? 1 point. KKPS, all this information are for KKPLC, right? Now, company bearing by market value. So the market value is 76. You can see they even differentiate it here. You can see you have equity is 76, debt is what? 24. Now, you also have the following financial data of PK. No, it's not PK, it's O. Okay, okay, let me leave it. Of PKPLC, let me leave it. A company in the same industry as the new what? So you can see that they've identified a company in that what? New for the new project, which is PKPLC. That is the policy company, right? They are the project Hope they mentioned. Maybe probably the name of the project is Project Hope. Yeah, we'll assume like that. But you can see the financial information of the company they are diversifying into, the equity beta and the what? The asset beta. You can see it. The market return, the risk free, and the tax required. Recommend a suitable discount rate for Project O. You can see they did not tell you that the cost of equity to be used to calculate the cost of equity. They say discount rate, and that is how somehow the question may come this way as well. Okay, recommend which of these discount rates are we giving? So you should know that, oh, this company wants to diversify, so you need to use an appropriate cost of capital, which is the discount rate that they will use to actually discount that particular project, and that discount factor will include what? Risk. Right. So now, suggested solution. Before we go, so anywhere we stop, you can complete it from your end. So the step one, number one, right? Let me just say number one. What is the policy company? Policy company. What is the policy company class? PK, right? PK PLC. Are we still together?
Yes, sir.
Okay, okay. Now, so the next step is to de-gear, right? De-gear or on-gear by removing the financial risk of the policy company, right? Now, let me bring out our format. Now, let me quickly bring out the full format. I'm coming. So, anywhere we stop, you can complete it. Okay, let's check. Okay. Don't forget to go back to watch the video again so that you can have more understanding of it. So let me put this one in. Okay, now in this question now, class, the asset beta, look at it, class. The asset beta, where is it? The asset beta of the policy company is given to us as 1.2. Save yourself stress. Save yourself what, class? save yourself stress. The asset beta is given. Just say BA equals to 1.2 is given in the what? In the question. Class, are we still together? Because they didn't give us the value of equity, value of debt, and the tax of PK. They give us, we have little information here. Is that not so? So therefore, your BA, don't forget that I've said it several times, right? Equals to 1.2 because it is given in the question, right? Step 3, we quickly move to step 3. Step 3, here is our formula for step 3, step 3, step 3. Okay, this is the formula. Let me copy this. Okay. Oh, 15 minutes. Wow. So you guys will complete it, sure. Okay, now the BE, right? We already know our BA equals to 1.2. Now let's check the beta debt. Don't forget the beta debt will be for the main company, right? Now let's check if the beta debt of the main company is given to us. If the beta debt of the main company is given to us. Beta debt is beta debt of the, look at, you can see the company's financials. You can see it. Is beta debt given to us in this question for KKPLC? Is it given? Beta debt. Did you
No.
see beta debt?
No.
Okay, no. Okay, so beta debt is equals to what? 0, right? Is equals to 0, right? What do you need again? You need the level of gearing so that you can identify what is the level of gearing here. Based on the question, let's check. Based on the question, don't form question for yourself. Oh, they just gave us, they even give us. Equity is 76, debt is 24%. You can see it here. Now, look at it in this question. They did not even indicate, in this question, they didn't indicate that is this gearing for KKPLC or PKPLC? Class, you can see that in this question, it was not indicated that is it KKPLC level of gearing or PK, the company they are diversifying into. It's part of the assumption you will state in your question. Now, in this type of question, now you can state it that the market value of 76 for equity and 24 of debt will be used for both KKPLC, and is an assumption. You just say assumption. The market value of 76% of equity, 24% of debt will be used for both KKPLC and as well as what. But for KKPLC and what? PKPLC is an assumption. State your assumption and move on. So this gearing now will be used for both KK and PK because we are given a limited information. Class, are we still together? So value of equity, that is 70 what? Is it 74? Class, okay, 76. 76. Then value of debt is 24. Class is what? Is 24. What is the tax rate? You still state your assumption. They're supposed to give you, sometimes they're supposed to give you different tax rates. Now you can see that they only give you one tax rate, which is 25%, right? Which is what? 25 what? 25%. So you still state your assumption. It is allowed. Class, assumption is allowed. In most questions, they will tell you state your assumption. It's part of what you will state in your assumption. So the tax is what? 25%. Right? 25%. 0.25. Right? Ideally, they're supposed to give you for the separate one, but we move ahead. So now, you can insert the formula here and put your answer. What do you have? Okay. What is this? What is this? Okay, you can have BA. What is the BA? 1.2 plus open bracket 1.2 because it's given minus 0, right? Close bracket. The VD, value of debt, is 24. Close bracket 1 minus 0.25, close bracket, then you divided by the value of what? The value of equity, right? The value of what? The value of equity. So class, I need figure so that we can move on. So what is the divided by the value of equity? 76%. So 76%, final answer.
1.48.
Thank
1.48.
you.
1.48.
God bless you. God bless you. That is the final answer. 1.4, 1.48. That is the final answer. So your equity beta is what? 1.48. What is the next step? You calculate the CAPM because all this risk-free and all that is given in the what? It's given in the question. So I'm coming, let me check. Okay, we have 10 minutes, okay? So now, the next thing is to calculate CAPM, right? Calculate, calculate CAPM, right? Calculate CAPM. So what is the formula? Let's quickly go back to, where is the formula? So I just want to copy it so that I won't waste my time. Okay. Don't forget that if you have risk premium, you will not have market return minus risk free. You will just put risk premium, right? Okay, where is it? Okay. Okay. So cost of equity. So what is risk free? Risk free is given in this question. Market return too is given in this question. Let's check. You can see market return. You can see your market return. You can see the market return as 15%, while the risk free is what? 6%. Market return is 15%, risk free is 6%, right? So we quickly go. Market return. Oh, okay. Market return is 15%. 15, okay, control Z. KE is equals to risk free is how many percent, sef? 6%, right? Is it
Yes.
6%?
Yes, sir.
Yes.
Okay,
6%.
6%. Okay, thank you. So what is your equity beta that you calculate? Equity beta is 1.48.
1.48.
Thank you. Market return is how many percent, sef? 15, right?
Yes, sir. 15%.
Okay, minus 6. So what is the cost of equity? Quickly. Quickly, what is the cost of equity?
9.32.
Okay, 1
9.32. 32.
9.32. Okay, 32%. Okay, 19. 19.
Yes.
Okay, it's fine.
My
Point
point
three
is
two. Okay, it's fine, it's fine.
Yeah.
So 5, WACC, right? Weighted average cost of capital. So what is the formula? Let me quickly pick the formula from there so that we can close today's class. Yeah, I'm tired already. So let's have WACC of this. Okay. So please follow as we move, right? I will upload it now, immediately after this class, right? If I do anything, I will upload. I'll make sure I upload it. Go back to it, watch. Then, so what is our formula? Don't forget that everything is for the main company, but the value of equity given to us in this question and the market value of equity given to us in this question, thank you, is just one. It is just one. So we assume it that is for the main company, right? It's part of your assumption that you state. Ideally, the value of equity that you're supposed to use supposed to be different. But since you are given one, so you use it as that and you state your assumption. There's nothing wrong in stating what? Assumption, right? So the value of equity given to you in the question, the value of equity, who is this? Exclusive. Exclusive. Any question, exclusive? Please put down your hands. Okay. The value of equity, exclusive. Do you have question for me?
So
Yes,
I was thinking,
please. I
the
want to just
tax.
confirm one thing. For this work, which of the capital structure, which of the gearing, is it for the proxy company or
I've,
for the main company? Sorry,
I've,
maybe I missed that part.
I've, yeah, I've said it several times. It is for the main company. It is for the main company, right? Since you are given only the market value, just one market value, you will assume that it is for the main company as well as for the opposing company. Use it and move on and state your assumption. Are we good? Exclusive?
Thank you.
Do you,
Thank
do,
you.
do you get? Do you get? Okay, madam,
Yes, sir. The tax, they said post tax. I was thinking the 1 minus C has been incorporated. We're
I
not
will get there. I
okay.
will get there. I will get there. I'm just bringing the variables out. We will get there. So the value of debt, right, is 24. That is the market value of debt to class. The cost of equity is, we've already calculated the cost of equity to be 19.32. That is why when you miss one step, you miss all, right? So the tax given to us in the question. Now, for the cost of debt, the cost of debt is given to us in this question, right? Let's check the cost of debt. What is the cost of debt? Now, the cost of debt is after tax. You can see it. The cost of debt is after tax, which means that they've already considered tax. So you don't need to do cost of debt 1 minus tax. You don't need to do it. It is after tax. I didn't mean they say it is post tax. That is when you will. So you just use the 8% and move on. You know, you're supposed to have KD 1 minus tax rate. But because it is after tax, so you don't need to, they've already considered the tax already, right? They've considered the what? The tax. So I think that's all. So fix it and calculate your weighted average cost of what? Weighted average cost of capital. So in our next class, we will look at more questions. This Zeco PLC, please, Zeco PLC is on the YouTube. Zeco PLC is on the YouTube. Go and check the cost of capital that they pre-recorded. I think, is it pre-recorded or live? Check risk adjusted cost of capital. Of course, I will attach it to the link that I will send to the platform. Check that link. Check it. The risk, this Zeco PLC, I've done it in that question. I've done it in that, it's on YouTube. Just go and watch this Zeco PLC, right? So if that is established, I will not do this Zeco PLC again. The solution is also here. I will send it to those who have actually paid. So that is Zeco PLC. So you see this question, the last question, maybe in our next class, we'll look at this question. This question is abducted from ACCA and Ican study pack as well as one of the tests. And experience has showed that when I look at this question and I look at it last night, I was like, this question maybe is examinable because it's technical, right? It's technical. Don't forget what they use the appropriate cost of capital to do when you want to diversify, right? You use the appropriate cost of capital to in order to include the risk of that what industry. That is what you will use to discount your project, right? The other partner will take you on that is Mr. Yobami Epiniza. We take you on the capital budget, right? And I'm sure he will still talk about the appropriate cost of capital when you want to discount the project, and we still talk about modified internal rate of return and all that under the what? Under the capital budget, right? So once we are done with this part, we will move to portfolio theory, right? We'll move to where? We'll move to